Hey there. It has been a couple months since we last spoke, but I wanted to get this into your hands so that you had something to look at and understand kind of what we're talking about. So this is an estate planning and life insurance strategy going over. Obviously, age 67, moving to Florida, net worth approximately 300 million plus, maybe 3 children. On a $300 million net worth, the potential estate tax liability for this year, if death occurred, would be $114 million. And so the objective with this design is to preserve wealth, provide liquidity, and fund the estate taxes that your children are potentially facing. So here's how we got to that calculation. If your estate's worth $300 million today, and you get a $13.6 million federal estate tax exemption. Now, again, the assumption here is I don't really know what other estate planning has been done. I don't know what other techniques have been used up to this point. This is assuming very little or nothing's been done, which I doubt is the issue. But if it were, because there are people that, don't do a lot, then, 13.6 million is the exemption. So you subtract that from the 300 million, and that leaves $286 million that's subject to estate taxes. And at a 40% estate tax, 40% of $286 million is $114 million of estate taxes. Now, that's due to the IRS 9 months after date of death in the form of cash. And that's where you see estate sales happening, liquidation. Your children, if you don't have proper planning or proper liquidity in place, your children have to sell assets at a fire sale real quick to get the money to pay the IRS. I mean, they're very stringent on that. So here's the solution. It's to use life insurance, but instead of paying the premiums out of pocket, which would be really high premium payments, it's to finance those. So we're going to use a third party to finance and fund those premiums and what that does is that preserves your liquidity while covering the estate tax. And the tax is income tax free and estate tax free when we structure it the right way. And just based off of some initial numbers we run, we're looking at a potential 10% IRR if you looked at it as an investment at age 100, 10% at age 100, so even better in the earlier years. And so here's what the structure would look like. We would use an index universal life insurance policy or a whole life policy, some type of permanent policy so that it's in force for a long time, and probably try to get over $120 million of death benefit, again, depending on what other planning you've already done. And we would stack different carriers to get you to that $120 million number. And then we would finance those premiums to cover the premium payments, right? The loan covers the premiums. And really what you're required to do is to pledge collateral. There's a portion of the cash value of the policy that the bank that's loaning the premiums uses as collateral for themselves. And when that's not sufficient to meet the outstanding loan balance, you have to cover the gap. And so we use the policy cash value and outside assets, some of the other assets. That way you can keep them invested and you don't have to divest, liquidate, sell, pay the tax to cover the collateral. You can keep them invested where they are, and we can just use them as collateral for the loan. So the typical lenders we would use in this size deal, JP Morgan, Northern Trust, US Bank, Capital One, maybe some of the smaller regional banks, next tier bank. And the loan amount we're probably going to need to look for is somewhere in the $9 to $10 million a year range for the next 10 years, because we're trying to get $120 million worth of death benefit coverage. And the interest rates right now are going to be anywhere between 5 to 7%, closer to 5% right now than 7%. But we would be able to fix that loan rate if we got to a point where we felt like the forward projection of interest rates is going to go up. We can lock that in. Loan payment, approximately $350,000 out of pocket, using your assets to pay that for 10 years. Not a requirement, don't have to pay the $350,000. What we don't pay out of pocket increases the potential pledge of collateral that you may need to make, or if we pay more, reduces the potential collateral. But your issue is not collateral, your issue is probably the liquidity inside of your overall portfolio to pay the estate taxes. So I don't think pledging collateral is going to be the issue. There's a limited guarantee, so you're not subject to the full outstanding loan balance. It's going to be just that slice of collateral, the additional gap collateral that you need to pledge. And initial projections, we're looking at a little over $5 million in year 7 is what the collateral pledge would be. Now, on a $300 million estate valuation, in the peak, pledging $5 million, so 6% of your overall net worth to cover $120 million of liquidity upon death. Maybe it makes sense, right? Something to think about. And then the strategy to exit the loan would either be upon your death, we would exit the loan with the bank with the gross cash or the gross death benefit of the policy, or we could pay it off with other assets that you may have, or we could look at refinancing it. So we have options on the loan portion. The process would be go through carrier selection. So we have to go through an underwriting process, whether we're using a combination of Pacific Life, Nationwide, Penn Mutual, John Hancock, New York Life, Mass Mutual, all the big carriers, right? We would go through a process of seeing how much they would all offer to put it all together like a portfolio of insurance. And then we would engage the premium finance lenders, JP Morgan, Northern Trust, et cetera. Probably be able to get this all at one lender, but sometimes we have to syndicate lenders together. Need to look at the trusts that you have established, working with your estate attorney for the proper life insurance trust, your revocable life insurance trust. And then go through the financial modeling. So once we understand the carrier, once we understand the lender, once we understand the type of trust that's going to own it, we can do the modeling of how it would all fit together. So you're understanding it and your estate attorney understands it, tax advisor understands it. And then to execute it, the carriers have applications, the lender has applications, there's underwriting and funding, et cetera. So I wanted to get this in your hands. I want to create that discussion with you. Call me back. Let's set up a time to talk. And talk to you soon. Bye.